Let's talk interest rates. I think we have to come back every now and then and talk about the macro. Even though we're not a macro fund, we invest in fundamentally new concepts and engineering practices. We're independent of the macro in the long run, but of course, in the short to midterm, we do depend on interest rates. I think long-term rates, the treasury, the 10-year treasury, are still very good indications for what we should expect in terms of the economy, and we are definitely affected by that through demand, through things like inflation, supply chain. So there's effects that we should be at least aware of. It's we have expressed that several times in this podcast. We don't trade around these things, and I think this episode will be a very pivotal episode because I'm going to just say it. We expect interest rates to plateau very soon and come back down. We don't think interest rates can rise much higher. We don't think we're even going to see 2% in the 10-year. And therefore, we expect, again, this whole inflation conversation to abate. We actually expect a recession to come, not too strong, but definitely a recession, and rates to stay in that corridor between 0 and 1.5% on the 10-year. This is an Onion Wrong podcast. It's February 9th, 2022. This is Krim Telco. For the day, the fund is down 2.1%. The market's down 1.3%. For the year, we're down 16.7%. The market's down 5.1%. We're underperforming by 11.6%. So let's talk about rates. Interest rates are not going to go much higher. Probably we are looking at the peak of the 10-year, the same way we're looking at peak inflation. Today, the inflation numbers came out. I don't even know which period, but they were higher than expected, 7.5%. People are saying this is the highest ever in the last 40 years. All of that, I think we've had that conversation several times. We don't want to go into details. The view here at Orange Capital Partners is the following. These supply chain issues will abate very, very quickly. And the supply chain issues are the main reason why we have inflation. What we had is basically a perfect storm in terms of money being sent to households and people not going to work, particularly sort of the middle to lower class type employees and workers and salary ranges. They actually got help from COVID privileges in terms of cash handouts and not having to pay rent and things like that, that almost made them better off than when they worked. So there was absolutely no incentive for them to go to work. In fact, some of them also couldn't go to work because of school closures. So the way we fought this pandemic was certainly not very effective on a health perspective, but absolutely catastrophic on an economic perspective. And we are paying the price now. Now, right now we have inflation. I think as we speak, this is abating because the privileges are being lifted in many countries, including the US, at least in various states. And if people start having to pay rent and being evicted and don't get money from the government just like that, then they're gonna have to go back to work, educate themselves, compete in the labor market, do all these things that we're used to. And when that happens, the supply chain issues will go away. So the inflation will go away on that front, and the inflation will also go away on the other front, which is the demand side, particularly things like buying furniture for your house and all that stuff. All of that demand is already abating, and it's going to continue to abate. Now, that means we're going to have a recession. We're going to have a slowdown in the economy. Demand will slow down, and therefore we're just going to have less production, less investment, the typical signs of recession. The silver lining is disruption, innovation, technological advancements. The three big sectors, genomics, AI, self-driving cars in particular, and interactive robots and blockchain technology. Those are the three big drivers of the next 10 to 20 years in terms of innovation and technology. We believe that, as we said many times in this podcast, this will not be affected. So innovation in AI and self-driving cars and electric cars, actually, I should have mentioned that also. I think I should rephrase that actually. The four big sectors. Okay, the four big sectors. This is a better way to phrase that. The four big sectors that will drive growth, employment, innovation, anything interesting, anything worth getting up to in the morning in the next 10 to 20 years are going to be number one, genomics, number two, electric cars and the decarbonization of the energy space. Third, interactive robots so meaning robots that can interact with humans, interact with traffic, things like that. And fourth, the blockchain technology, which actually can be used in some of the applications in the first three instances. So those are the four big innovative vectors that we believe are independent of things like interest rates and all that. We have a very bad situation in the economy. I think our macro picture actually looks very bleak because the deterioration of government institutions, starting with the White House all the way down to state capitals, is unfortunately still continuing. There's some improvement, particularly on the state level in states like Texas and Florida, etc. But overall, we still have a massive deterioration in government institutions, and that, of course, will make lives more difficult for people. The only silver lining there is that people will be incentivized to go to work and educate themselves, and particularly train themselves for higher level tasks, because this is the key for an innovative economy. I think the US economy is in good footing, particularly compared to China and Russia and Europe, because we are still absolutely at the forefront of innovation. All those four sectors that I mentioned, so genomics, CRISPR, gene editing, then the decarbonization of fossil fuels or of the energy space, and then AI and blockchain, all of that is happening here more than anywhere else in the world. I also include China there. I'm not too concerned about China. I think China is in a situation where, almost like the Soviet Union, we are massively overestimating the power of China, because the government is just not capable of managing the economy in a productive way. They're able to manage the economy. They're able to scare people. They're able to control everybody, but it's not very productive. And we here in the US have a much more dynamic, much more market-driven, and therefore productive economy. So, but when it comes to the macro outlook for the next, let's say, 18 months, again, rates are peaking. We believe that we're actually right now looking at the highest 10-year rates that we're going to see in a long time. Also, inflation is peaking. We're going to have a deceleration of the economy, probably a recession, which will be maybe a quarter or two of pain, but then the actual innovative technologies, particularly the electric self-driving cars driven by Tesla, the autonomous robots, the revolution in manufacturing that comes with that, and the whole revolution in gene editing and CRISPR on the healthcare side will drive economic growth going forward. So we believe we will have a massive acceleration of growth, of productive growth. That might not show in GDP numbers and all that, but that doesn't matter. There will be plenty of very interesting jobs. There also will be lots of dislocations in the economy, but there will be plenty of very well-paying jobs for people, for younger people that are listening, maybe that are not sure what they should be doing. Just try to get a master's or a PhD in one of those four fields. Again, gene editing, genomics, second, decarbonization of energy space, so things like material science, battery technology, distribution, solar, distribution of electricity, AI interaction, robot interaction. There's a very good master's program just offered by Stanford, meaning just offered. It's a relatively new. It's robotics and autonomous systems, where they tackle exactly the problem of interaction between robots and people. So they build robots that can interact with people, that can be used on the road as self-driving cars, or that can be used in the factory, and many other instances. And then, of course, blockchain technology. That's a bit of a bigger space that I'm not very familiar with. We have some investments in blockchain technology beyond Bitcoin, beyond Ethereum and Algorand. But overall, of course, that space in itself has a lot of different vectors also that we're not familiar with. But overall, I think if you believe in solving the decision-making in decentralized frameworks, and then find more efficient ways to, let's say, remunerate participants in decentralized frameworks, I think those are very interesting applications that can be also monetized, and businesses can be built around that. So to summarize, this is a macro call that we're coming out today. We're saying that interest rates are peaking, that we believe that we will have a relatively mild recession. Maybe it will be bumpy in the first few weeks, but it will be mild because the recession will be driven by people on the one hand, their demand will come down, so there's no more money to be spent because you have to start paying rent and all that. At least that's the way we are right now. Of course, we could have a new variant of the virus and things could change again and all that. But let's leave it at that now. We will have peak inflation and the start of a recession. Rates are peaking. We will have a slowdown in the economy, which will be offset by the 4 innovative factors, which is, again, gene editing, genomics, second, decarbonization of the energy sector, third, AI, interactive robotics, and fourth, blockchain technology. Now, before I go, I just want to reiterate why we are comfortable with our portfolio. You might say, well, you're predicting a recession. Why aren't you selling stuff? Now, here's the thing. Our largest position is Tesla. So I'm going to focus on Tesla here. Tesla has a product that is much better and at a lower cost than any kind of competing product. We've said in several instances on this podcast that we see Tesla is in the business of providing transportation, and they'll be able to lower the cost of transportation at least by 50%, if not more, and more importantly, also increase the quality and value of transportation, such as, it's more entertaining, more comfortable, all that stuff. So you have a increase of several fold in terms of value, so in terms of cost reduction and value increase. So having said that, we believe that a product like that, a service like that, of course, will survive through the times, will be able to keep growing, and will gain market share regardless of the macro. Of course, in the short run, we could see a bump in, let's say, inventories at Tesla for a short time, because there will be mismatches in production, inventory, and if there's demand shocks, even Tesla can't undo that. But nevertheless, we believe that because the product is so superior to everybody else, that there is a very good chance that Tesla will get through this unscathed. We think that nevertheless, the market, like we said, could have a different idea about this. So we see a downside of maybe around $600. So that's another 30% downside from here. That's kind of where we see the max in Tesla's pain. Some of that is priced, some of that is not priced, as we can see in the stock. Stock is 900, could be 600. That depends how the demand shock will come out. I think some of it is, like I said, priced in the stock. Otherwise, the stock will be 1,200 already. We don't know. They could, let's say, slow down the expansion in Austin and Berlin. So there are things that Tesla can do to mitigate the shock should it happen. But again, over the long term, we definitely don't see a problem with Tesla. In fact, this will strengthen Tesla. The same way Apple came out stronger of the 2008 recession, Amazon came out stronger out of the internet bubble burst in the early 2000s. The same way Tesla will come out stronger and reach much, much higher all-time highs in terms of market cap than we have seen even in stocks like Apple or any other kind of comp today. So I just wanted to reiterate that. Some people ask me, well, if you predict a recession, why don't you sell? We don't trade around these things for several reasons. I mean, there's a very simple reason, a tax reason. Even after tax, if you sell and then rebuy and things, you could actually end up making almost no money, even if you're right with your calls. But that's not the point. The point is we are not very good. We don't have technology. We don't have the know-how to actually trade around these things at the right time in the right place. We don't have that. We have not invested in that kind of technology. We also are not interested in that for several reasons. What we are interested in is deploy capital to long-term disruptive technologies, which are technologies with fundamentally new concepts and engineering practices are deployed to, let's say, like I said, things like decarbonization of energy, the genome editing and revolution in healthcare, and then, of course, also the AI side of things. Thank you.